There is one signal, and only one, that truly matters. Jesse Livermore dedicated his entire life to its mastery. He called it the line of least resistance. This was the central unifying principle of his entire speculative philosophy. It was the great underlying truth that governed every trade he ever made. He saw that the market, for all its complexity, was not a random chaos. It was a magnificent, impersonal force, and like any great force of nature, it followed a predictable path. Prices, he understood, do not move erratically. They move in the direction that offers the least obstruction. They will do whatever comes easiest. The speculator's entire job, as Livermore defined it, was to identify this path, this invisible current, and to align his own operations with its powerful, irresistible flow. To attempt to trade against this line was, in his view, the height of folly. It was to pit one's own finite resources and fallible judgment against the full, crushing weight of the primary market trend. It was like trying to swim against a powerful river current. A man might struggle valiantly for a time, but his exhaustion and his eventual defeat were a certainty. The wise speculator, he knew, does not fight the current. He does not argue with the tape. He learns to read the water, to identify the direction of the flow, and he allows that great impersonal force to carry him toward his destination. For those who are committed to a deeper, more methodical study of the principles that governed Livermore's legendary career, the essential text remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below. What then is this line of least resistance? It is not a prediction of the future. It is a diagnosis of the present. It is the final summative expression of all the forces, known and unknown, that are acting upon a stock or upon the market as a whole. Every earnings report, every dividend announcement, every political development, every whisper of inside information, and every hope and fear of every participant in the market, all these myriad factors are distilled down into one simple, observable reality, the price action on the ticker tape. The direction in which that price is currently moving with the greatest ease is the line of least resistance. Livermore knew it was a fool's errand to try and untangle all the individual reasons behind a market move. The tape, he said, does not concern itself with the why and wherefore. It doesn't go into explanations. The reasons for a stock's advance might not become clear for days or weeks or months. To wait for those reasons is to miss the opportunity entirely. The professional speculator's business is with the now, not the tomorrow. His job is to see what is happening, not to guess what might happen. The line of least resistance is the market's present truth, and that is the only truth that matters. This concept stands in stark opposition to the methods of the average trader. The amateur is always seeking reasons. He wants to be told why a stock is a good buy. He is swayed by stories, by narratives of future growth or hidden value. Livermore knew this was a dangerous distraction. A stock is a good buy not because of a story, but because the buying pressure is greater than the selling pressure. A stock is a good sell not because of a bearish rumor, but because the selling is overwhelming the buying. These are the only fundamental facts that concern a speculator, and they are revealed not in a newspaper but on the tape. To identify this line requires a profound shift in perspective. It requires the speculator to stop looking for tips and to start looking at the market's own behavior. It is a matter of pure, dispassionate observation. When the line of least resistance is upward, advances will be strong, vigorous, and sustained. The reactions, the pullbacks, will be shallow and brief, occurring on lighter volume. The stock will feel hard to buy, its price seemingly always just out of reach. This is the character of a bull move. Conversely, when the line of least resistance is downward, the declines will be sharp, persistent, and relentless. The rallies, when they occur, will be feeble and short-lived, gasping for air before being overwhelmed by another wave of selling. The stock will feel heavy, unable to sustain any upward momentum. This is the character of a bear move. To recognize this character, this personality of the price action, is to recognize the direction of the underlying force. This is not a matter of guesswork or intuition. It is a skill developed through years of focused, methodical observation. It is the result of keeping records, of studying past movements, and of learning the market's habits. Livermore was a fanatic in this regard, a tireless student of the tape. He knew that while the players and the stocks might change, the patterns of human psychology, and therefore the patterns of price movement, remained eternally the same. History was constantly repeating itself on the ticker, providing a roadmap for those who had the discipline to study it. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Furthermore, we recognize that the wisdom of the markets is not confined to a single individual. The history of speculation is rich with masters who, while sharing Livermore's core respect for risk, developed their own unique styles. From the mechanical box theory of Nicholas Darvas, to the volume spread analysis of Richard Wyckoff, to the turtle trading system of Richard Dennis, from the deep value principles of Peter Lynch, to the pioneering trend analysis of Charles Dow and the modern psychological insights of Ed Sikota. There is a pantheon of genius to study. To explore this rich history, we have launched a new channel dedicated to the diverse strategies of the world's greatest traders and investors. If you wish to broaden your understanding, the link to this new channel is in the description below. The most critical moments for identifying a shift in the line of least resistance occur at Livermore's pivotal points. These are the great strategic junctures where the market makes its decision. A breakout above a major resistance level, a pivotal point, is the market's own clear announcement that the path of least resistance has now turned decisively upward. It is the moment the invisible current becomes visible, the signal that the time for waiting is over and the time for action has begun. Livermore used his initial trades not just as a way to enter the market, but as a way to test the line of least resistance. He would send out a probe, a small exploratory position in the direction he believed the market was headed. The market's reaction to this probe was his final confirmation. If the trade was easy to execute and immediately showed a profit, it was a sign that he was in harmony with the underlying current. He was moving with the flow. This was the signal to press his advantage, to add to his position with confidence. If, however, his initial trade met with heavy resistance, if it was difficult to accumulate his line without driving the price up, or if it immediately showed a loss, it was an equally clear signal. It was the market telling him that he was wrong, that he was trying to swim against the current. He would not argue. He would not hope. He would accept the market's verdict and exit the trade immediately. This method of testing the waters prevented him from ever committing his full capital against the primary trend. The wise speculator, then, is not a man who has a firm, unchangeable opinion about the market. He is a man who has a flexible, open mind. He understands that his own ideas are worthless until they are confirmed by the only thing that matters, the action of the market itself. To identify and follow the line of least resistance is to achieve a state of intellectual humility, to accept that the market is always the master and the speculator is but its student. It is to abandon the ego's desire to predict and to embrace the professional's discipline of observation and reaction. This was the philosophical core of Livermore's genius, the great and simple secret that was the source of his legendary fortunes. To recognize the line of least resistance is to possess the map of the market. But a map, however accurate, is useless to the traveler who does not know how to act upon its information. It is not enough to simply see the great underlying trend. The professional speculator must have a clear, disciplined, and systematic methodology for capitalizing on it. Jesse Livermore did not just identify the current. He built a complete operational framework for navigating it. This framework covered the three critical phases of any great campaign: the precise moment of entry, the patient management of the position, and the unemotional, signal-based exit. Once the line of least resistance had declared itself, typically through the decisive breach of a pivotal point, Livermore's first rule of engagement came into play. He would not charge into the market with his entire force at once. Such an act was for the reckless plunger, the amateur driven by greed. His first move was always a probe, a small exploratory commitment. This was his final practical test of the market's readiness. He had a core belief, forged in the crucible of thousands of trades. The real money made in speculating has been in commitments in a stock or commodity showing a profit right from the start. If this initial probe, this first 100 shares, did not immediately move in his favor, it was a clear sign that he was wrong, at least in his timing. The line of least resistance was not yet as clear as he had thought. He would not wait or hope. He would exit the trade, taking a small, insignificant loss. But if that first commitment showed a quick and decisive profit, it was the market's own final confirmation. It was the green light, the signal that his judgment was correct and that he was in perfect harmony with the market's primary force. It was only then, after receiving this tangible monetary proof of his correctness, that he would begin to build his main line. This was the science of pyramiding, the art of adding to a winning position. His rule was absolute. Each succeeding purchase must be at a higher price than the previous one. He would add to his position on a rising scale, his commitment growing in direct proportion to his success. This ensured that his largest bets were always placed on what was already a winning campaign, financed, in effect, by the market's own favorable movement. He was reinforcing success, not failure. With his position established and the trend moving powerfully in his favor, the most difficult and most profitable phase of the operation began: the art of sitting tight. Livermore stated, in what is perhaps his most famous piece of wisdom, "It never was my thinking that made the big money for me. It always was my sitting." He knew that the great fortune-making profits were not found in the nervous day-to-day fluctuations, but in riding the great primary trend for weeks and sometimes for months on end. This required a level of patience and courage that is almost beyond the comprehension of the average trader. It is the ability to hold a large and profitable position through the inevitable, natural reactions, the frightening but healthy pullbacks that are a normal part of every major move. The amateur, terrified of losing his paper profits, is shaken out on these reactions. The professional, his confidence anchored to his reading of the primary trend, holds firm. He knows these are merely pauses in the great advance, not a reversal of it. While riding the trend, the speculator must learn to ignore the noise. In a great bull market, the newspapers will be filled with bearish stories, with warnings of impending corrections, with reasons why the advance cannot possibly continue. In a bear market, they will be filled with hopeful rumors of a bottom and an imminent recovery. Livermore knew that to listen to this chorus of confusion was fatal. He stated, "In bull markets, bear items are ignored and bull news exaggerated and vice versa." The only news that mattered was the news being written by the ticker tape itself. As long as the price action continued to confirm the line of least resistance, all other opinions were irrelevant. He even found that the unexpected, the accidents of the market, tended to favor the man who was trading in harmony with the primary trend. He said, My experience has been that accidents, that is, the unexpected or unforeseen, have always helped me in my market position whenever the latter has been based upon my determination of the line of least resistance. To trade with the trend is to put the powerful unseen probabilities of the market on your side. It is to sail with the wind and the tide at your back. But no trend, no matter how powerful, lasts forever. The final and most critical part of the professional's operation is to recognize, without emotion or regret, the moment that the great line of least resistance begins to bend and finally to break. The first warning sign for Livermore was a change in the market's rhythm. It was the reaction without a rally. If a stock, after a long advance, had a normal pullback, but then failed to resume its climb to a new high, it was a signal that the upward buying pressure was exhausted. The great engine of the trend was losing its power. This was a danger signal of the highest order, a time for supreme caution. But the final, definitive, and non-negotiable exit signal was the violation of a reversal pivotal point. This was the moment the stock broke below the low of its last natural reaction. It was the market's own clear mechanical announcement that the primary upward trend was over. The battle had been lost, and the sellers were now in control. The line of least resistance had irrevocably shifted from upward to downward. When this signal was given, the time for sitting was over. The time for action had arrived. A speculator's loyalty is not to the bull side or the bear side, but to the right side. And the right side had now changed. The professional sells out his line not because he is guessing at the top, but because his own disciplined, systematic reading of the market has told him that the great move has run its course. He preserves his profits, protects his capital, and prepares his mind for the next great opportunity, which may now lie on the short side of the very same stock. This, then, is the complete operational framework for trading the line of least resistance. It is a journey from patient observation to decisive action. It begins with the discipline to wait for the market to declare its intentions at a pivotal point. It continues with the courage to build a position on strength, to pyramid a winning trade. It requires the immense fortitude to sit tight, to ride the great trend through all its frightening but normal reactions. And it concludes with the unemotional, signal-based discipline to exit the moment the market's own behavior confirms that the great underlying force has finally turned. This is not a system for gamblers. It is a business plan for serious speculators. It is a method that transforms the market from a chaotic mystery into a logical, understandable field of operation. It requires work, it demands patience, and above all, it demands a profound level of self-control. But for the trader who is willing to master it, it offers the only true and reliable signal he will ever need. It is the market's own roadmap to fortune, a path revealed not to the hopeful or the fearful, but to the patient, the disciplined, and the observant.